Hey, it's Alex. Welcome back to Three Clowns, episode 10, Thursday, April 17th. So we finally cracked 7,000 on the S&P yesterday. AI semis absolutely carrying us there, but here's the thing. The 10-year keeps climbing even as stocks rally. Oil's melting on ceasefire hopes, and literally every prediction we made this week expires tomorrow at close. So we've got Tom and Ray here to sort out whether this is a rotation we should worry about or just noise. Let's go.
Yesterday, I was in a grocery store where the same bottle of olive oil had two different prices depending on which shelf you picked it up from. Nobody questioned it. They just chose the reality they preferred and moved on.
Oh man, Tom, that is the most perfect metaphor for the S&P hitting 7,000 while the 10-year yield is basically screaming fire in a crowded theater. Yesterday, I spent about an hour staring at the Fed data on credit spreads, and it feels exactly like your olive oil. Investors are just grabbing the growth narrative and ignoring the fact that the actual cost of money is getting more expensive behind their backs. We've collectively decided that if the AI story is good enough, we can just ignore the shelf where the interest rates are marked up.
S&P at 7,000 while the 10 years going up is... We've priced perfection and financing it with a variable rate mortgage, which historically ends very calmly.
Okay, so here's what we actually saw yesterday. TSMC beat, AMD exploded 7.8%. That pulled the entire semiconductor complex higher. And then, this is the key part, systematic money just kept showing up. We're talking $19 billion in equity buying last week and another $40 billion expected this week, which means the S&P crossing 7,000 wasn't some careful, reasoned revaluation. It was flow meeting narrative meeting the fact that every algorithm in the world suddenly had permission to buy. Meanwhile, the 10-year yield just climbed to 4.309. It went up 2.7 basis points overnight while the market was rallying, which should probably bother us more than it does. And oil? Yesterday it was up 2.65% on energy strength. Today it's down 2.5 pre-market because Trump's feeling optimistic about Iran's ceasefire talks. So we've got the AI mega-cap momentum story still humming, the refinancing cost of that story getting visibly more expensive, and geopolitical risk just whipsawing based on what someone said in a tweet. The real question is whether those things are still compatible, because here's the thing. All 5 predictions we made this week expire tomorrow at close. And look at our scoreboard, man. Tom's 1 for 7, I'm 0 for 6. Ray's 0 for 4. So either the market's telling us something we're fundamentally misreading, or we're just getting randomly dunked on. Let's find out which one it is.
Well, being 0 for 4 feels about right when the bond market is basically trying to stage dive into a mosh pit that isn't there yet. See, when yields climb while the S&P is hitting 7,000, that's the bond market admitting the inflation fire is still smoldering in the floorboards. It means the AI fixes everything narrative is going to have to start paying a much higher rent for its office space because the cost of capital isn't coming down to save us. Yesterday, I was looking at the term premium, and it's clear the market is just ignoring the higher for longer reality to chase the semis. We're all celebrating at the party while the bank is quietly changing the locks on the front door.
Yeah, and that's the thing. The locks are changing in real time and we're all just pretending we didn't hear the click. So today we need to figure out whether the S&P can actually keep running when the cost of borrowing is going the wrong direction, or if we're about to get a very expensive lesson in why those two things eventually have to point the same way. Let's hit the tape and see what actually moved overnight. All right, so the S&P closed just over 7,000 yesterday, which sounds momentous until you look at the actual tape. 250-plus names down on the day, even as we're printing all-time highs. This is what $19 billion in CTA and hedge fund buying actually looks like when it shows up. The index goes up, the market breadth goes down, and you're left wondering if we just witnessed a rally or a liquidity event. AMD exploded 7.8% on the back of TSMC's beat and raise, which is the obvious story. But here's what I want to understand. We've got $40 billion more in systematic buying supposedly lined up this week. The 10-year yield just climbed to 4.309. Oil's melting because Trump's suddenly optimistic about Iran. And all of that's somehow supposed to keep working together at the same time. So, Tom, before we get into the chip cycle, Walk me through what you saw yesterday. Does a 250-name down move on a 7,000 S&P close feel normal to you? Or are we actually watching the narrowness get worse?
No, that's not normal. That's a very polite version of a narrow top. You've got an index at all-time highs where most stocks are not invited. That usually means the buying isn't, "I love this business," it's, "My model says I have to buy this basket right now." The CTA flow is just rate vol math. Yields up, growth duration bid, shove it into the same 10 names again and call it diversification. When the index makes a record and the median stock doesn't, you're not looking at strength. You're looking at weighting. AMD up 7.8% is just TSMC's earnings wearing a different hat. The conviction is still upstream, still in the picks and shovels, not the guys telling you they'll use them. So Ray, if this whole thing is basically a rate trade in disguise, what happens when the disguise stops fitting?
Well, Tom, it's like that old saying about the basement fire. You don't smell the smoke because you're too busy looking at the new wallpaper in the living room. Look, that 10-year yield at 4.309 is the real story here, because it's creeping up while the index hits records, and that usually means the market is just choosing to ignore the cost of capital to chase the momentum. If you're paying $7,000 for the S&P while the 10-year is north of 4.3, you aren't just buying AI growth. You're betting that the physics of the discount rate don't actually apply to the top 10 names, which is a bold strategy. Yesterday, I spent 20 minutes watching my neighbor try to grill in a windstorm. The flame kept going out, but he just kept turning the gas up. And that's the CTA flow right now, just pouring gas on a flickering flame regardless of the weather. But then you look at oil. Yesterday, we're up 2.65% on Hormuz fears, and today we've basically wiped it all out, down 2.5% because of a Trump headline. When oil swings 5% in 24 hours on pure sentiment, it tells you the market has no real conviction on the macro floor. It's just reacting to the loudest voice in the room to find some liquidity. Alex, is this oil dump actually about a ceasefire? Or is the market just terrified that high energy prices are the one thing that finally forces the Fed to kill the party?
You're right, Ray. That's exactly it. Oil's doing the 5% windstorm thing because the market doesn't actually have a floor conviction on where energy should trade right now. Yesterday it was Iran closes the strait, premiums explode, which is a real scenario, don't get me wrong. But the second Trump says something peachy about a ceasefire, suddenly that risk premium vanishes and the oil ETF's down 2.5. The thing is, oil execs spent months pushing Trump to resist letting Iran tax Hormuz traffic, so there's real corporate lobbying underneath this. But when you're whipsawing 5% in 2 days on headlines, what you're actually seeing is that nobody, not traders, not hedgers, not the strategists, has built a stable model for where crude should live given the actual geopolitical facts. It's just ping-ponging between war premium and Trump's optimistic, with nothing in between. That's a market looking for an adult in the room, and it's not finding one. On QVC filing for Chapter 11, that's just visual proof that the consumer's still rotating away from novelty shopping and toward things that don't require a TV at 3 in the morning. $5 billion in debt haircut says the legacy retail math is fully broken. Eagle Rock's IPO is testing whether the window's actually open, and Schroders and Nuveen's $9.9 billion deal is the latest reminder that consolidation in asset management is the only way left to hit margins. But neither of those move the needle today. What does move the needle, though, is CNBC reporting that regulators are now probing trades that happened right before Trump's social posts, which means somebody's finally asking whether the information asymmetry between Mar-a-Lago and the rest of the market has gotten too wide. That's not a headline. That's a slow-motion regulatory problem waiting to wake up.
Oil doing ping-pong isn't volatility. It's the market admitting it has no model for simultaneous supply friction and demand optimism. You've got geopolitics tightening barrels, while equities price in AI making energy intensity irrelevant. Those two things only agree right before something breaks.
It's that collision between the dream and the gas pump, Tom. And the reason it breaks is that we're trying to build an AI future on top of an inflation basement that's still flooding with structural energy costs. Eventually, the market has to stop pretending the basement is dry. because you can't price in a productivity miracle when the literal power bill is still rising.
So what Ray's saying is the AI narrative keeps getting priced like it's a free lunch, when really we're just stacking robots on top of an energy cost problem that doesn't go away, and that math breaks eventually. Let's hit the footnotes.
Okay, so here's the one the tape doesn't make obvious. Gold is on track for its fourth straight weekly gain. Now that sounds boring until you put it next to the ceasefire headlines. You'd expect gold to give back some of this run if Iran war risk is genuinely fading, right? Safe haven demand goes down, gold goes down. But instead it's sitting near all-time highs, while the oil ETF just whipsawed 5% in 2 days on pure sentiment. What that tells me is the market isn't buying the ceasefire as a structural fix to anything. Gold isn't rallying on fear right now. It's rallying on something more durable. Dollar uncertainty, long-term inflation expectations, and the fact that central banks globally have been steady buyers. So when Tom says the basement is still flooding, the gold chart is basically the moisture detector. And then you layer the systematic buying on top. Goldman's data shows CTAs bought around $19 billion in equity last week, and another $40 billion is supposed to land this week. So the index goes to 7,000, while the median stock goes nowhere. Gold stays bid even as war risk eases, and the same systematic models are chasing momentum in the same 10 names. At some point, those two data points, gold rising and CTAs all in on equities, have to stop coexisting without something breaking. Alex, is the gold bid just hedge funds running a barbell, or is there a message in it we're not reading right?
I think it's the barbell, but the barbell itself is the message. If you're buying AI momentum with one hand and gold with the other, you're not actually confident. You're just hedged for the possibility that you're wrong about everything, which, given our scoreboard, is a rational position. On the oil side, the oil ETF already faded 2.5% pre-market on the Trump ceasefire tone, which we covered in the tape. But the footnotes angle is what happened the day before. U.S. oil executives were lobbying Trump specifically not to let Iran toll Hormuz traffic. That's not the market. That's the Permian Basin telling the president the geopolitical risk premium is actually load-bearing for their business model. The same week an Iran deal headline wipes out the oil premium is the same week American energy companies are explicitly asking the government to keep the threat alive. Those two things being true simultaneously says something about how fragile the energy price consensus is.
The oil execs want the fear, the market wants the deal, and the president is going to post whatever's in front of him. That's not a market. That's a mood board.
Tom, that is the most precise thing you've said all week. And it connects directly to the UK story. Rachel Reeves announced yesterday that the government wants to break the structural link between gas prices and electricity prices. For context, in the UK, the way power markets are priced, the marginal cost of gas basically sets the price for all electricity, including wind and solar. So when gas spikes on a Hormuz headline, your renewable power bill goes up too. Breaking that link is the structural play, not a band-aid, but rewiring the pricing model so energy costs stop amplifying every geopolitical sentiment swing. The reason it matters to us is that the AI infrastructure build-out has the exact same problem globally. Hyperscalers are locking in nuclear power agreements to escape this dynamic, the same way Reeves is trying to escape it legislatively. Different tools, same underlying problem. You can't build the next decade of compute on top of an energy cost that moves with someone's optimism about a ceasefire. The UK is just being more honest about needing to fix the foundation.
Reeves is trying to legislate away the mood board. That's ambitious. What she actually gets is a multi-decade regulatory fight and a utility sector that is very, very upset about it.
And the last footnote, the one that might actually matter most as the week closes. CNBC reported that regulators are now probing trades placed right before Trump's market-moving social posts. This has been the worst-kept secret in systematic trading for the past year. If you had any signal, direct or indirect, about when a Trump post was coming, the trade was essentially free money in both directions. And now somebody's finally asking whether the information flow between Mar-a-Lago and whatever desk was first to move constitutes an actual market integrity problem. The probe itself probably doesn't move anything this week, but the day it names a name, every desk that's been running a Trump social media signal has to decide whether to hold, close, or pray. That's a lot of desks.
And that's the quiet systemic risk hiding behind the 7,000 print. Not the yields, not the oil, but the possibility that a non-trivial slice of the market's alpha has been generated from information that isn't supposed to be tradable. If that probe goes anywhere, the unwind isn't a slow rotation. It's somebody turns the lights on and everybody runs for the door at once, which is very basement fire energy, honestly.
The Trump probe is the thread that ties all of this together. Systematic buying built on momentum, energy prices built on headlines, and now a question mark over whether some of that alpha was built on information it shouldn't have been. The actual mechanic behind the chip cycle that's been driving all of this, that's Nerd Corner. Nerd Corner. TSMC beat and raised. AMD exploded 7.8%. NVDA actually went slightly negative on the same day. Tom, you've been in the semiconductor stuff all week. Walk us through what the foundry raise actually means and why AMD got the bigger pop.
So TSMC is the company that physically makes everyone's chips. NVIDIA, AMD, Apple, Qualcomm, all fabless designers. They outsource fabrication to TSMC's fabs in Taiwan. Which means when TSMC raises forward guidance, it's the upstream signal that can't be manufactured by PR. A chip designer can say, "Demand is great, AI is going to the moon." That's just an earnings call. But when the foundry raises numbers, it means the purchase orders are already placed and physically flowing through the fabs. The beat and raise isn't an opinion on AI demand. It's a receipt. And AMD went up 7.8 while NVIDIA went down 0.25% on the same day. Which is interesting. AMD is still trading at a meaningful discount to NVIDIA's multiple. NVIDIA's been priced for AI works and only NVIDIA wins for over a year. TSMC raising guidance doesn't change NVIDIA's thesis, it confirms it, so the incremental buyer who wanted to express that trade was already in. AMD is a different trade. It's TSMC confirms the foundry is actually running hot, therefore AMD's data center GPU production allocation is real, therefore the second mover thesis isn't dead. That's a larger percentage move because it's closing a discount, not adding to a premium. The uncomfortable read is that NVIDIA being flat to down on a strong foundry day is actually healthy. It means the market is starting to allocate on relative value instead of momentum, which is how cycles mature. The question is whether maturation looks like rational rotation, or everyone sells the leaders and then everything corrects together.
So the receipt says the AI CapEx cycle is still accelerating. But if demand is accelerating and every hyperscaler is ordering more chips, the power build also has to keep up, right? Because you can't run more GPUs without more megawatts. Does the TSMC beat actually put more pressure on the energy side of the AI story? Or does the market just choose not to connect those two things?
The market explicitly doesn't connect them. That's the entire trade. TSMC confirms accelerating chip demand. Every major hyperscaler is at max data center CapEx, and the energy infrastructure, nuclear agreements, new gas capacity, grid interconnection queues, is running on a completely different timeline. Chips go from order to fab in 12 to 18 months. Power infrastructure takes years. So the AI CapEx cycle just confirmed it's still accelerating, and the energy side it depends on is not going to be ready at the same speed. That gap is where the next supply constraint comes from. Not semiconductors, power. Which is what the oil story, the UK story, and the gold story were all pointing at this morning from different angles.
So TSMC's raise tells you the chip half of AI infrastructure is healthy and accelerating. Everything else we covered today tells you the energy half is structurally constrained and politically volatile. The most hyped technology cycle in a generation, healthy at one level of the stack, precarious at the one below it. That's Nerd Corner. Let's go score some predictions. Okay, calls. Let me just put the full picture on the table. 5 predictions still live. All of them expire by tomorrow's close. Ray, your episode 5 call is the first one out. 10-year yield at 4.42% by today's close. It's sitting at 4.309 right now. 11 basis points away with less than a session left. What's the path?
There isn't one. When I made that call, the yield was moving on oil and Hormuz fears were building. I thought we'd get a genuine inflation scare that pushed the 10-year through 440. Instead, we got oil whipsawing on ceasefire headlines and the 10-year just sitting here. It's not going to 442 today. That's 0 for 4 locked in, and it looks like 5 after today closes. The reverse signal has officially gone three-dimensional.
5 predictions expiring. 3 of them are just different bets on where the 10-year lands tomorrow. Mine needs it above 435. Ray's needs it at 415. Alex's needs it between 422 and 428. It's currently at 430.09. We are all wrong simultaneously in 3 different directions.
And somehow that's the most coherent summary of this week's macro picture I've heard. The one that's actually alive is my episode 7 call, the QQQs above 625 by Friday. That's been locked since Tuesday. The QQQs closed at 640 yesterday. Unless something genuinely catastrophic happens before the bell tomorrow, I'm going to get one right, which means either the market is being kind or I accidentally called the only thing that wasn't difficult.
To be fair, the reverse signal finally stopped working in your favor for about 24 hours. Tom's episode 8 call is the one I feel for. 10-year above 435 and NVDA down more than 5% from the episode 8 level. NVIDIA closed above 198 yesterday. The parlay needs it below 186.68. That's a significant move in one day.
Both legs are losing. The thesis was that the Besant rally would unwind when rates stopped falling. Rates didn't stop falling. They went up a little bit instead, which is somehow more demoralizing because it means the bond market is moving, but just not enough for any of us to be right about anything. The parlay required a clean macro break. What we got was a moderate drift. Medium wrong is worse than spectacularly wrong. Spectacular at least gives you a story.
Starting Monday, we're switching to daily calls. 1 prediction per person per episode, expires at that day's close, scored next episode. No more 5 bets expiring on a Friday, no more parlays, no more week-long yield guessing. Every morning we make a call, every episode we find out. Which seems like a more efficient way to be wrong. That's episode 10. See you tomorrow.